welcome to the first session. It's a great session despite the fact that I'm having three roles in it. It's the first time in my experience, being session chair, discussant, and presenter. But we have at least two great papers plus mine, and very happy to introduce the first one, presented by Jinpei Cheng, Technology of Cryptocurrency Evaluation, Evidence from Machine Learning. You have 20 minutes.
Thank you, Evgeny. Also, first, I would like to thank Paul and Lan for organizing this wonderful conference. As we briefly chat this year has been really difficult, and to everyone, so I really appreciate the opportunity that we can have some, online communication with each other. And of course, this conference will be much better if it's in person in Miami. So my name is Jinpei Cheng. I'm from University of California, Irvine. The paper I'm going to talk about today is about how do we understand technology in cryptocurrency evaluation. The motivation of the of this paper is that cryptocurrency market has become more and more important. As many of you have heard, the performance of Bitcoin actually recently is extraordinary. It has been reaching about almost 50K US dollar, right? Per Bitcoin. Now at the same time, still, Bitcoin has been around more about 11 years. And there's all type of coins. There's over 6,000, 7,000, auto coins, etc. Since Bitcoin was launched, there's always a debate about cryptocurrency, and this type of debate is actually growing while the cryptocurrency market has been growing. On the one hand, people think that the blockchain technology is great. Cryptocurrency is also revolutionary in many ways, and in particular, people think that the technology behind cryptocurrency, which is blockchain technology, is revolutionary. And people think it's the new internet is like electricity back to older days. But at the same time, as a growing concern about whether it's about speculation, right? So I want to share a newspaper actually with you. This says that I just actually just find like a few news articles. All of them are questioning about these cryptocurrency. They think that many of these ICOs are scams, are fraud, etc. So definitely there's a lot of concern about how much of these crypto market is driven by technology rather than behavioral or other factors. One of the central questions in this debate is whether, as I mentioned, whether technology matters, right? We have been talking about blockchain technology, how great this technology is, but how much of these, cryptocurrency market is driven by technology innovation rather than a market sentiment? So in this paper, we focus on technology sophistication, where the technology sophistication of crypto market affect their valuation. Now, you may wonder why we focus on technology, right? There's probably many aspects. And one reason is we believe that this is one of the central topic in the debate about, whether cryptocurrency is interesting, a valuable asset class. Many investors believe blockchain technology that has been used in cryptocurrency is so important. And there's also importantly, there's a lot of theory in this area mentioned that they predict in the theory and saying that technology is super important for many things, evaluation, platform building, etc. But there's no empirical study that systematically studies this question. So therefore, we focus on technological sophistication of cryptocurrencies. Now, there's one challenge in that we are facing is that how do we measure technology sophistication for these cryptos? because there's a very limited there are a lot of cryptos, but they have very limited informations. So crypto is very special asset class. They don't have like a quarterly disclosure. Like it's not like stocks, right? You've got 10K, 10Q, a lot of information. Not much information there. There are limited information. So in this paper, we focus on self-disclosure, which is white paper. White paper is actually arguably the most important disclosure that each cryptos need to be disclosed. Not needed to be, but like most of them were disclosed when they launch their cryptos. Now, once we have this, another challenge we are facing is that we have to deal with text data. In this paper, we use several machine learning methods to construct so-called tech index to capture technology sophistication. We use both supervised and unsupervised machine learning methods like LDA, word embedding, and you may wonder why we use machine learning. Why we not use like simple method, like just count the words, etc. If the simple method can do the same work, isn't this better? Which I agree, right? I don't want to. I'm not saying that the simple method doesn't work, because myself actually has a paper use simple word count and my course as well. Um, so so the simple word count method is actually particularly powerful if we know what we are looking for. If we know that we are looking for consumption risk, a real disaster risk, or any macro risk like unemployment, inflation, etc., then we should just use simple word count, and that works out perfectly in this paper and also in this literature. But cryptos and blockchain technology are new phenomena. So how many of us can, even I taught this fintech course for 3 years, how many of us can claim that, oh, we know this space very well? So the challenge is that every year there's no new concept phenomena can pop up. And also it takes time for people to understand what's going on. So in this case, our strategy is that let the machine learn tell us what type of topic is there, and then we will make the decision about what it is. So that's kind of the motivation why we use machine learning method rather than the simple word count. But we do also use simple word count. Just that we found the machine learning method is better. I'm going to show you the result later on. Now, interest of time, I may probably couldn't finish everything, but I just want to give you some preview of the result. What we do here is that essentially for all these cryptocurrencies that we have white papers, we construct the technology index using machine learning. We found that the ICOs or cryptos that have higher text index are more likely to get funding, more likely to succeed. In terms of getting funding, being listed on the crypto exchanges, and also they are less likely to get delisted later on crypto exchanges, and also in long run they have better performance. They are, but in short run, actually their performance is not different. I'm gonna tell you why later on. So overall, we kind of go back to the debate, right, whether these technology matters for the company for these cryptos. We found that overall we found these technology aspect is actually important, is an important driving force for the crypto valuation. This paper contributed to a growing literature that many of these panelists actually are contributing. So we contribute to the theory literature that they emphasize that technology matter, but our contribution is to construct a measure about technology sophistication and show that empirically indeed technology matter for crypto valuation. We also contribute to the empirical literature that many of the papers. I only list a few of here, but the paper we are writing aside more papers. There's empirical literature document, what type of factors that affect the crypto ICO performance, and we provide some new insight about the role of technology sophistication in explaining ICO success, ICO underpricing, and performance. All of these are important topics has been discussed in this literature. And the last contribution is on the method side. We contribute to the machine learning and text analysis in finance. This is also relatively young literature. People have been contributing to, and we are one of the first paper that use machine learning method to conduct the analysis in the crypto market. Now, let me actually introduce a little bit about how we measure technology sophistication for these cryptos. We call tech index. So the data is actually quite common. So we use some popular website to get the data. Now, for the ICO, surprisingly, we're starting from actually 4,000 ICOs. We ended up actually getting about 1,700 ICO white papers. So although many of these cryptos have white papers, but if you want to open it, if you want to download it, actually there's some problem with getting the white papers. But still, I think we get most of these white paper documents. Now, how do we construct these tech index? Essentially, we use both supervised and unsupervised machine learning. The supervised machine learning method is that we manually read through about 200 white papers, and we give a score about how how sophisticated we think the technology is involved in these cryptos, and then we use these as training sample, and then we train the sample and explore the remaining over 1,000 cryptos. So the advantage of this is that we kind of mimic the way investors evaluate the white papers. Then again, as I mentioned before, right? So, although we probably know a little bit about cryptocurrencies, but again, our understanding about cryptos is always limited because of new phenomena. So in this case, I think unsupervised machine learning have some advantages. So we let the machine learn first, and then we will make decisions. So the advantage of unsupervised machine learning is that it requires only little human input and expert knowledge. So what we do is we use two types of unsupervised machine learning methods. One is word embedding. What we do is, well, we use word embedding to map words to different topics, and then we find also the optimal number of topics, which is 20. And then once we use these word embedding method to get the topics, we get the list of words, then we name of each topics. Similarly, we do the same thing for LDA. We also build 20 topics, and then we label these topics. And then in the end, we found that the topics that we believe that is closely related to the technology, blockchain technology, and then the index itself is a fraction of words that belong to these topics. Then we have three, right? I mean, we have three tech index: one supervised, two unsupervised. Then we have the composite index. We want to kind of take advantage of all these methods, so which is simple average of these three index above. Now, for many of these risk analysis I'm going to present today, we will focus on the tech composite index, but the results are similar if we use all the other tech index. Now, I just want to give you a flavor about how we how we construct these in tech index. So here's an example that we use LDA. So what we are doing is that essentially, the first thing we want to get is we get the topics. We get 20 topics. As you can see from the right part of the figure, we got 20 topics. Topics range from blockchain, social media, etc. Now, once we got these topics, we need to also group them. It's not only one topic that is relevant for technology. So essentially, we use a method that a hierarchy, a structural method to group these topics into different types. And we found that there's at least three topics, which is about information, blockchain, system, That's what our name, right? As our labor. We judge that by looking at these keywords. We found these three topics is essentially very close to the technology that we were been talking about. So now the weights of these three topics in each document is going to be so-called the tech index. Now this is for LDA. The same procedure has been applied to the word embedding. So the difference between word embedding and LDA is that when we find the topic, we use different method. So the word embedding will consider the geographical meaning from one word to another word when finding the topics. Whereas LDA will actually do not consider that. That's kind of, advantage of one method, disadvantage of another method. We just try both. The first,
5 minutes.
yes, go ahead.
5 minutes.
5 minutes. Okay. Yeah, let me actually go through quickly. So the first thing we want to look at is about, you may wonder what determine these tech index, right? We look at quite a bit of variables, and here's a table I want just quickly briefly talk about. We found that the tech index makes sense, and if you use Israel, then the tech index is lower, means that less sophisticated, right? We know Israel is very popular, and but not that sophisticated. There's definitely blockchain technologies that are more sophisticated than the Israel platform. We also look at several measures from GitHub. We found that if there's more commit in the GitHub, then the tech index is higher, meaning it's more sophisticated, which is also makes sense. Of course, we also check other measures, but as they are actually also the result is intuitive. Okay? I'm gonna skip the rest. Now I want to talk about, you may wonder how this tech index related to the performance. We look at a few measures. One thing we look at is whether this related to fundings, and which is whether they get successfully get funding. Here is actually successfully listed on the crypto exchange. We found the result shows that if the tech index is higher, then you're more likely to get funding or you get trading on the exchange. Okay, so indeed, actually, there's a positive association here. We also look at short-term and long-term return of these ICOs. We found that in short run, there's no difference between the tech index, between cryptos have a high tech index and lower tech index. Okay? However, if you look at long term, which is about over 180 days, indeed, if you have a higher tech index, you are more you are likely to have a better performance. So in that sense, it suggests that eventually actually they recognize the crypto have more sophisticated technology than the cryptos have less sophisticated technologies, but it takes time, right? So if you put these two results together, is that at the beginning probably the investors do not really tell which one is better, in terms of technology, but in long run, if your cryptos have better technologies, the investors do appreciate that, and it reflects in the return. Now, they're also less likely to delist. Usually it's a bad consequence, right? If it's not good, it's going to delist. We also compare to the other measure, simple word count, the number of commit in the tech index. We found that, these tech index, these tech measure also matter, but if we consider that our result is still there, is also very, is also have stronger result than the other measures. And the simple word count, it matters, but it's observed once we have these tech index. I believe I'm already on time, so I do have other results if you want. We do look at a bunch of robustness, reversal, etc. as well. But in interest time, I would just conclude here. So overall, our paper construct a set of 4 tech-based technology index to study a comprehensive sample of ICO white papers. We showed that technology sophistication indeed matter for the valuation of cryptocurrencies. Although it takes time actually for investors to realize how good one crypto is, how good it is in terms of their technologies. And actually, our finding have important policy implication in terms of how should they disclose the technology and all relevant component for the cryptocurrency when it comes to writing up their white papers. Thank you very much.
Thank you very much, Jinfei. You were right on time. It's fantastic. Makes my job easier. Let me try to share my screen as I'm supposed to be the discussant. Can you get to my screen?
Yes.
Yeah. Okay, fantastic. All right, so thank you very much for the organizers, to the organizers for asking to discuss this paper, which I found very interesting. So let me first kind of very briefly introduce or summarize the research question, and then say a few things about what I liked about the paper and what could be potentially improved. So I think that the big research question is what are the determinants of success in initial coin offerings? And the reason the question is important is that the process, as we all know, is completely unregulated. And there's not too much information available for to investors when deciding whether to invest in particular ICOs. And one crucial source of information about ICOs is the white paper that the entrepreneurs basically provide investors usually prior to the ICO. In my own reading of white papers, their sophistication, varies widely, from really sophisticated computer science type papers to kind of undergraduate business plans. And obviously it is important what kind of white paper we're looking at if you are an investor thinking about investing in an ICO, right? And so what this paper does is it basically looks at the relation between different machine learning based measures of sophistication of white papers and different measures of ICO success. Which measures of ICO success? Well, there are a few in the literature, and this paper is quite ambitious in looking at many of them. So things like likelihood of obtaining funds in the ICO, likelihood of listing on one of the crypto exchanges, the further return, or what we call underpricing in the traditional kind of IPO setting, and returns after ICOs over various horizons, right? And generally, with one exception of underpricing further returns, the evidence is that more sophisticated white papers tend to succeed more both in the short term and the long term. I think that's the general kind of finding. All right. So what I liked and what I liked less about the paper. So there are a lot of things to like here. So I think the research question is super interesting, not just for people interested in ICOs, but given the techniques are so nice, it should be interesting to many other types of people as well. The machine learning techniques, as far as I can tell, are really state of the art, right? There are many of them that are fantastically implemented, and if anybody wants to start learning about different types of machine learning techniques, maybe the online appendix to the paper is a good place to start. It's really well written and very self-explanatory. I really enjoyed reading. Overall, the results findings are quite strong, and the paper is really one of those papers that is fun to read. So really enjoyed it, and again thank the organizers for giving me this particular paper to discuss. So there's three things that I think could be improved further. The first one is data collection, the second is empirical analysis, and the third one is kind of discussing more what can we take out of this paper beyond the particular ICO market, right? And in the remaining 5 minutes that I have, I'm going to basically elaborate on those three points. All right. So data. So there are three main data sources in this paper. We need data on ICOs. It comes from this website trackico.com. It's not the largest sample of literature. It's about 3,000 ICOs. There are papers that have more. There are papers with 5,000, 6,000 ICOs. I'm not sure it introduces selection bias, but it needs to be discussed. Now, I don't typically put two of my papers on one slide in the discussion. This is an exception rather than the rule. But I do have a paper where we discuss the quality of ICO data, and we come to the conclusion that the quality varies widely, across both kind of websites or aggregators that track the data and different variables that are being tracked, right? So I'm not saying that you should use data from from dozen sources, but you should somehow examine how the data from track ICO, whether the data from track ICO is reliable, and maybe do some sample analysis for subsets of ICOs for which the data is more reliable than for others. Now, the returns and volume data come from CoinMarketCap. That's a standard kind of data source for many studies of academic studies of ICOs. From what I can tell, it gives good data on daily returns. It basically aggregates daily returns from different crypto exchanges and does a decent job with that. It's not a great data source on trading volume, and there is part of the paper examining trading volume. The reason is that many exchanges seem to inflate volume. And the paper I'm going to be presenting next is going to be about that. So I'm going to take the volume results sort of with a grain of salt. Now, the most important thing is the white paper data. It also comes from track ICOs. Now, issue with white paper data is that there's not one white paper for a project that's available online. White papers tend to be updated frequently, both before ICOs and after ICOs, right? So if you want to look at how white paper informativeness or sophistication affects ICO outcomes, we obviously need pre-ICO data. Now, a potential solution to this look-ahead bias would be to read just the version of the white paper that's available prior to the ICO. Now, all of the numbers that I mentioned here are from our own paper, so in this setting, the numbers may be way different, but this is just kind of to give you a sense of what we found. So in our sample, in our paper, over half of white paper did not specify date. In 18% of the white papers, only the year of publication is being specified. And so you have 25% of white papers with precise date. But in only 1/3 of those cases, the date of the white paper was preceding the ICO and within, I think, 3 months of the ICO. So relatively close to the ICO. So I'm not sure exactly what the solution is. We haven't found a solution, in our case. But maybe this is something to think and do some sub-sample analysis for white papers whose date we clearly know and whose contents have not been back filed. All right. The machine learning. So as I mentioned, the machine learning analysis is just amazing, and I learned personally a lot. I am less sure I understood the supervised machine learning part. So I'm just quoting a few things from the paper. So the process closely imitates the way investors evaluate the white papers. We read through 200 randomly selected white papers, and then the readers assign a score. So I'm not sure who the readers are, whether it's all the 3 authors or one of them, and how that's determined. And generally, some more details on the process, would be, I think, useful here. And then the choice of the machine learning approach is basically done by regressing, the scores from the training sample on validation sample and doing various permutations of the sample. And the choice parameter is the highest R-square, right? And, the highest R-square is 45%. I'm not kind of in this literature. I'm not sure whether this is a large or a small number. What are the R-squares using other methods, and are the results generally robust to the choice of the method? I think that some discussion could be useful. All right. There's as I mentioned, there's a huge literature by now looking at determinants of ICO success, and there are 2 types of measures that have been kind of studied: measures based on white papers and other non-white paper based measures. There are a couple of other measures that have been introduced. So, for example, Florisek and Channelbauer look at the kind of non-standardization of white paper, which they interpret as informativeness. We use simpler things in our paper, such as length and the proportion of technical words in the white paper. Yours is clearly a superior method for doing things, but I think controlling for other existing kind of determinants, would make sense. And then there is a lot of non-white paper based determinants of ICO success. I'm listing a few here, such as percentage of token retention, GitHub production, not just the dummy variable, but the time series evolution of it. Same thing for social media activity and adoption as approximated by the number of wallets or the number of wallets transactions and things of this sort. I think, kind of to claim that a sophistication white paper is really important for results, it is important to control for this thing because of the potential omitted variable bias, which I'm not sure it is here, but you need to make sure that it's not. All right. And then finally, kind of the big question is, this is a fantastically executed paper in this particular setting of ICOs. Now, we all know that ICOs, there are fewer of them nowadays than before, right? So it's not clear that general readership is going to be interested in ICO topic in particular. And so I think it's important to generalize this a bit and talk about what takeaways are there for other settings or markets. I'm mentioning here a few settings here, one related to the other paper that Gustavo is going to present later on in this session. But you can think of many other things where your methodology can be used, and I would encourage you to use it in other settings as well, just to make this more interesting and useful to a wider audience. But overall, I just want to say that really well done paper, well written one, and I truly recommend everybody to read it. All right, so I think I ate a little bit of my own time from the presentation, but if there are questions, for the next couple of minutes, it would be great, if people ask them, and if not, maybe we can do an additional Q&A at the end of the session. So, are there any questions from the audience?
I had a comment more than a question. There is a paper by Will Kong that does very similar things in terms of the topic identification. They use word embedding instead of this LDA, but they also develop a bunch of methodology on how to optimally tune the parameters and how to apply it to extract kind of topics from economic text data. So that could be something to look into as well.
Yeah, Gustav, thanks. We do also use word embedding as well, LDA, both of them. But we do definitely need to look into that paper as well. Yeah. Can I? Do we have time? I can just quickly respond probably to Evgeny's.
Sure.
Just briefly first. Thank you very much. I think the discussion is wonderful, and so we have been working on this paper since 2018. So some of the sample we definitely need to update. So at that time, I think that these website, this data source has been quite a standard, but I definitely seen a change in the past 2 years about what's the optimal data sets. I hope that we have this CRISPR version of crypto data, right? It's gonna be wonderful. We just go there. That part we are looking for that, and we should update that. And as you mentioned, we start from about 3,000 data, and we end up only about half of these have white papers. Indeed, right? We kind of confirm y'all. So we have been we do some manual check, but if there's no white paper, there's nothing we can do. Definitely about the machine learning, supervised machine learning, we should add more details about what we did. Essentially, we have 5 people read up these 200 white papers, and we take average score. So we have three authors, and then we also hired RAs who have been also have some knowledge about the fintech. And then we have this average of these 5 people. But we should add more of these details on that. Yeah, thank you very much. I also will be more than happy to take any questions. Now or later on. Thank you very much.
All right, thank you very much, Jitte. So I think I'll move on to the second paper, which is my own. Do you guys still see my screen?
Yeah.
Okay, fantastic. So, so this paper is co-authored by 2 of my colleagues here in Tel Aviv, Dan Amiram and Daniel Robetti, who is a PhD student, who is going to be in the market probably next year. So if you see the name, please give him some consideration. And so the paper is about competition and product quality. And what we're going to be doing is we're going to be looking at cryptographic exchanges, and that's why this paper is in this session. All right, let me spend just a minute kind of motivating what we're doing. So there is a large industrial organization literature highlighting product quality as basically a type of product market competition between firms, or a type of operating strategy of firms, particularly those producing experience goods. And those are defined as products whose quality you cannot observe ex ante, but that you can eventually see exposed. Right? There are some models generally in IO about this, and also in the setting of particular industries that I mentioned. Right? The trade-off is pretty simple, right? So if you want to fake the quality of your products, then you're likely to increase your short-term profits at an expense of your reputation, and so longer-term profits are going to suffer. Now the question is, what's the effect of competition on this trade-off between the short-term and long-term incentives? And the effect of competition actually may be ambiguous. So on one hand, an increase in competition decreases the future rents that firms are going to realize or expect to be realized in the future. That decreases the costs of damaged reputation and decreases product quality because short-term becomes more important than the long-term. On the other hand, if there's higher competition, then consumers' outside options are larger. That means that reputation becomes more important, and so product quality and equilibrium is going to increase. Right? So we're basically going to try to see, which of those two effects is stronger. There are some existing studies of this question, usually in the context of a particular industry, such as supermarkets or airlines. And in those two examples, product quality seems to be increasing in competition. But more closely, what we are interested in, the case of experience goods, there is only one study that I know of, and that is of credit rating agencies by Becker and Milburn, and they actually show that there's a negative relation between product quality and competition, as measured in their case by entry of Fitch into the rating industry. Right? Now, we are going to look at crypto exchanges. Now, the reasons we are going to look at crypto exchanges are threefold. First, in this setting, they have an easily implementable technology for faking quality or for misleading consumers about the quality of their product. Right? How do they do it? Well, they can easily inflate the reported volume of on the exchanges by means of fake or wash trading. There are simple ways that they can actually implement it, and it's for free. Now, why is this important? Well, because if you are an investor, a trader that decides, where to trade, this is basically the first thing that you're going to look at, right? So volume is usually synonymous with market depth and with a lower product cost, trading costs. And so typically you're going to go to an exchange with a higher volume. In addition, a lot of aggregator websites, such as CoinMarketCap, rank exchanges based on basically trading volume with some adjustments, right? So trading volume is a really important signal for investors where to trade, and so the signal of exchange quality. In addition, there are two kind of important elements for this relation between product quality, choice, and reputation, and both are satisfied in the setting of crypto exchanges. So first, the quality of the product is unobservable ex ante, right? So you can only see the reported volume, but you don't really know what's going to be the trading costs and what is the market depth and so forth. But then eventually, as you start trading, you can actually see what the quality is because you observe, the costs and how your trades are being implemented, right? But that takes time. In addition, this crypto exchange market is very unique in how it's structured because competition has many layers. On one hand, exchanges are heterogeneous, both operationally in terms of what cryptocurrency pairs they list and geographically. In addition, competition between multiple trading platforms within a given currency pair is basically competition in homogeneous goods, other than the potential quality of the exchange, right? So we have a lot of things to kind of to play with when we examine the effects of competition on exchanges' incentives to fake trading and to fake the quality of the product they deliver. There are a couple of existing studies. All of them are still working papers. So Song, Li, Tang, and Yang basically show that 70% of, or estimated 70% of trading volume of on top 3 cryptocurrencies on unregulated exchanges is fake. Alush and Lee use an example of Mt. Gox exchange, for a short period of time, but they basically have a smoking gun evidence because they actually see fake trades directly as opposed to estimating them, and they estimate that up to a third of volume is being fake. And there's some well-known industry studies such as the Bitwise report about a year and a half ago that basically suggested that 95% of Bitcoin trading volume is fake. Now, what the different thing between us and the existing academic and industry papers is that the existing papers are mostly interested in estimating and documenting fake trading, Now, we also do this, or try to do this, but our focus is mainly on the determinants and consequences of fake trading. So why firms fake trade, what types of exchanges do this more, and whether it makes sense, right? Whether they're better off in the short and the long run if they do. All right, I'm going to skip most of the pictures. This is the evolution of the crypto market. Our data only goes until September of 2019. We're going to update it soon. Once we do, clearly the market cap of crypto market is well over $1 trillion right now, way more than in this graph. Now this graph is interesting. So the gray bars show the number of distinct currency pairs, such as Bitcoin against Ether, trading on different exchanges. And these downward sloping lines are basically Herfindahl indices of exchanges based on different variables such as number of trades or volume or number of currency pair. Basically, you can see that this exchange market has been becoming more and more competitive over time, right? So Herfindahl went down from 1 in 2016, basically a single exchange, to something like 0.12 right now, which is a big reduction and a big increase in competitiveness. Our data, very briefly. Our main data set is ICO, which is fantastic. It provides details on pretty much every aggregate transaction on actually a bigger number, close to 100 crypto exchanges, including the price, volume, timestamp, and the pair. We use just 41 major exchanges in our data, and those are defined as those trading in at least one major currency, which is Bitcoin, Ether, or Tether. But those are all the big exchanges that are responsible for over 90% of reported trading volume. So we're basically capturing most of the market in the data, and we have a bunch of additional data sources that I won't have time to go over. Let me skip the summary stats. Let me just give you some illustrations of what I mean by fake trading, right? So let's look at the upper two pictures. The right one shows trading of a coin, of a pair of OMG coin against Bitcoin in January 2019 on Binance, which usually is considered to be a kind of a decently operating exchange. And the left graph shows the same thing on OPEX, another exchange, right? So just to a naked eye, it seems like the trading volume is is quite random on Binance. There are some structural breaks on OPEX, right? At least four, that I can see here with the naked eye. And the lower graph shows the same thing with the number of trades instead of volume, and the picture is quite similar. That's another example. So it's another pair. So it's Ether against Bitcoin. So the most important pair of all in the crypto market. And again, on Binance, it seems like trading is quite random, but there's some strange spikes on ZB exchange. And if you look at the number of trades, those spikes are have basically a fixed frequency, which seems non-random at all and might suggest some fake trading. There are many examples like this. I'm going to skip them, and I'm going to move to measuring fake trading, right? Because you cannot look at every graph and try to see whether there is one or not. There's just too much data. So if I want to quote someone from the industry, then a good person to do that would be the head of research at CoinMarketCap, which is the biggest aggregator of trading data for crypto. And he says that there is no way to tell if an exchange is inflating volume or not by merely looking at the volume they report. The only way to detect what trades would require access to account ID data, and only exchanges have access to this data, right? And so we have to, like everybody else, we have to resort to indirect or statistical measures. We use three. I won't have time to go over them, but basically they're based on, the first one is based on the so-called Benford law, that is kind of the distribution of the digits of the first digits of either volume or trade series. In most distribution without an upper limit, they're supposed to behave according to a certain law, where number one appears in about 30% of the cases, number two appears in 19%, and so forth. The second measure we use is distance from log normable distribution, because if there is no manipulation, it has been shown in the for stocks basically that volume is approximately log normal distributed. And then the last method that I like the most is basically we use the machine learning method it's called EDM or E-divided with medians. We basically try to estimate the number of structural breaks in the data throughout a given sample period, right? And then eventually we're going to aggregate all three measures into kind of one principal component-based measure and use it as our measure of fake trading and kind of see whether, what are the determinants of this measure of fake trading and what are the consequences of it. Let me skip many of the pictures. Let me just show you how this EDM algorithm works in one example. So if you look at the right picture, basically the algorithm detects no structural breaks. If you look at the left picture, it detects 4 of them, right? And those are exactly the breaks in the locations that would be detected with the naked eye. What's also interesting or important is that this last kind of spike in trading volume that happens around towards the end of the sample period, so that's a month, right? And the periods here are 10-minute intervals, for which we aggregate the volume. Basically, the algorithm does not detect the break, around the last spike, which is nice, and the reason is that it's based on medians rather than means of permutations of the data, right? But overall, as I said, we basically do a principal component analysis of those two measures and derive just one measure that we use in the empirical test. When I say one, it's one for volume-based data, one for trading-based data, and one for data when we use both volume and the number. All right, so the result is the following. The first result is we can measure basically the fake trading at the level of crypto exchange currency per month. So that's kind of the finest kind of measurement possible. But then we aggregate these measures along different dimensions. For example, this is along the time dimension. We can see that fake trading, regardless of how we measure it, has been increasing over time, in particular in the last couple of years in the sample, has been much larger than before. We can also look at which currency pairs are more prone to fake trading, and you can see here that the blue circles and the green rectangles are most prone to fake trading. And those are Ethereum against Bitcoin and Tether against Bitcoin. So two of the largest pairs are more prone to faking by exchanges. And we obviously didn't use size, to say anything, to measure anything, right? So that basically means that exchanges tend to fake trading where it matters, right? Where there are a lot of trading to begin with, and where volume can be inflated by a lot. All right. We try to validate our measures using many different ways. So first, we look at what types of exchanges have high and low measures, and we find that exchanges with the highest web popularity, the oldest exchanges, regulated exchanges, have some of the lowest estimates of fake trading. And some of the problematic exchanges that have been subject to some bad kind of reporting or bad news actually have some of the highest estimates of fake trading in our data, and that's reassuring, right? That our numbers make some sense. We also look at different characteristics of exchanges to see whether they're correlated with fake trading, and things that you think like usual suspects such as anti-money laundering measures, know your customer requirements, web popularity, social media, and so forth. They're all correlated with fake trading measures in predictable ways. So that's another good thing. I'll skip this one. We also use a natural experiment, which is banned by China in 2017, of exchanges operating there, where the exchanges moved to other locations, mostly in Southeast Asia. And we show that after this move, into more regulated environments, fake trading has decreased by a lot. And so that again is reassuring as to whether our measures, which are purely statistical, whether they make sense. Now, let me spend the last 2 or 3 minutes on the results that we get, right? And that's basically computation among exchanges and fake trading. So let me show just one regression about that. So what we do here is we look at what happens to fake trading in a given currency pair, on a given exchange, when a new competitor arrives in the market or when a competitor leaves the market, right? And a competitor can be any exchange that starts trading or ceases trading in a given currency pair. That's the general competitors. It also can be geographical. That's a subset of general competitors that operate in the same geographical area, because it has been shown that geography is important in this market. And then operational competitor is the exchange that tends to trade similar currency pairs, right? So we compare all the kind of list of currency pairs traded on exchanges and find the closest competitor in that regard. And what we can see here, and I want you to look at just the last column and at the red numbers there. When a competitor enters, basically there is more fake trading. When a competitor exits, there is less fake trading, and those effects are basically exacerbated, when the initial competition is high, right? So it seems like dynamically, when competition increases, exchanges are prone to fake more. When it decreases, exchanges are prone to fake less. What are the consequences of fake trading? We look at a couple of things. We look at trading volume, and we look at commissions, estimated commissions, and we also look at basically the web popularity of the exchange. I'm going to show you just a couple of results. If you look at a 3-month horizon, faking trading over the last 3 months increases both web popularity and estimated exchange revenue by a lot. Those are standardized by the in-sample standard deviation. So one standard deviation increase in faking increases the web popularity of the exchange over the next 3 months by 1.5 standard deviation, which is huge. On the other hand, when you go to 12-month horizon, the results reverse completely, right? So if you fake trading 12 months ago, that is going to reduce your popularity in 12 months and also reduce your estimated revenue, right? So exactly kind of as the intuition goes, fake trading has some short-term benefits, but eventually the market learns and the costs are going to be in the long term. All right, just to conclude, so we look at effects of competition among crypto exchanges on the incentives to fake trading volume, right? We showed very briefly in this presentation that there is a positive relation between competition and volume inflation. I only showed you the dynamic results, but the static results show similar picture. Fake trading is effective in the short run, but has long run reputational costs. And the contributions that I see is to the general kind of IO literature examining competition and product quality choices of firms in this particular setting of crypto exchanges, where we find consistent with other papers in the area that there is pervasive volume inflation, and obviously that has implications for regulation. All right, I went 1 minute over time. Gustavo, the floor is yours.
Okay, here we go. That's working. Great. Well, thank you so much for giving me the opportunity to discuss this paper. Kenny's a good friend of mine, so it's going to be a nice discussion. Nope, don't go ahead yet. There we go. So I'll jump right into it. So the paper is very nice. It essentially studies the interaction between product quality choice and competition for experienced goods. And what's really nice about the paper is that it uses cryptocurrencies as kind of as an experiment. So it analyzes cryptocurrency exchanges facing this trade-off. And the way it measures product quality is by looking at liquidity, so the amount of volume that an exchange reports, and in particular looking at artificial amounts of liquidity. So the contributions are twofold. I think the first contribution is a methodological contribution in deriving measures and ways to detect fake trading volume at exchanges. And then it utilizes these measures to kind of understand the trade-off between competition and product quality, and shows that for these kind of experienced goods, stronger competition implies higher likelihood of engaging in liquidity faking. So essentially, competition in this market skews kind of the product quality choice downward. What this tells us is that exchanges are ultimately prioritizing short-term gains over long-term costs that are associated with kind of reporting fake trading volumes. And interestingly, in doing this analysis, the paper also shows that around 20% of reported trading volumes are fake. So what I'm going to focus on in my discussion, the paper is really great. And one thing I love about the paper is that it really uses cryptocurrency markets to make inferences for more general settings, which is something that's very hard to pull off, but really, really powerful. I'm very much convinced on the competition effects that are highlighted. So I'm not going to talk a lot about that. What I'm mostly going to focus on is trying to understand whether first volume is really the right kind of proxy for product quality, especially in this market. Then I'm going to talk a little bit about whether we really need machine learning in this setting, and I think we do, but I think maybe justifying and motivating it a little bit more could be helpful. Not for me personally, but I think when selling the paper to other audiences that maybe that are not so highly technically skilled. And then ultimately, I'm just going to pose the question of whether it's a good or a bad thing, actually, that exchanges are faking volume. So I'm going to jump straight into this. So the assumption here is made that reported volume is in a way a proxy for product quality. And that's generally kind of an insight that's taken from equities market, where the exchange depth is associated with the ease with which investors can execute trades. Now, for equities, that really matters because we have very large institutional investors that are moving a lot of money with each one of their trades. But I was a bit puzzled of whether this is really that important for cryptocurrency markets, because we know that cryptocurrency trades tend to be relatively small. So I took some data points on this. I found that Blog Research estimated back in August of 2019 that the average trade size on Bitstamp, Itbit, and Gemini, which are the three exchanges that back then had the largest institutional trading, was around $4,500. So these are small trades. Then ICO, the same data provider that Evgeny uses in his paper, in June 2020, kind of assessed the average trade size across different exchanges among the highest volume trading pairs, and found that the average sizes are less than 1 Bitcoin. So these tend to be small trade sizes, consistent with the notion that we've been hearing that people trading in cryptocurrency markets, at least before the recent boom, were primarily like smaller retail investors. Now, if this is the case, then trading volume is really not that important for these investors. Like, what they really care about more than anything is what are the prices that they're going to be trading at. The small trades that they can execute, that they want to execute, they can really execute regardless of what the liquidity of the exchange is. And so I was kind of thinking about what happens when we think about a different proxy for quality, namely prices, for example, like quoted prices. And this is based also on some of my own experiences that I've had. I'm on the board of directors of an exchange in Australia, and recently they had one of the competitors went down for like an hour, and we had a doubling in trading volume that day. And what we saw is that what people were really interested in and why they were coming to us was primarily associated with the prices that we were quoting. So all the inquiries that we got that day was like, what are these prices? How are they determined? Are we going to get the best possible prices? So, and this really matters because the way these exchanges work is generally like the same cryptocurrency may be traded on many different exchanges, and therefore different exchanges may offer better prices at which investors can trade at. So what I wanted to see is that, well, if this fake trading volume is really associated with product quality, then maybe there's also an association with the kind of prices that investors view in these exchanges that do more fake trading. So I ran some experiments to see whether this is actually in the data. I did not have access to Evgeny's data, but I used something like alternative proxies for trade volume. And I went to Nomics. I downloaded data on 28 exchanges that are also in the paper. And Nomics reports something like the transparency rating of the exchanges. So what Nomics does, it aggregates also at the trade level and like at the millisecond level, I think, data from all sorts of exchanges, but it then also rates exchanges based on the ease with which they provide data to kind of aggregate these data points. So the transparency rating is more associated with the reliability of the trading data rather than with like the truthfulness of the trading data. So it's a little bit different than what Evgeny has in his paper, but I think it's still interesting to see nonetheless. So what I wanted to do is see whether this rating is associated with deviations from aggregate prices. So my conjecture was that if an exchange is really, if fake volume or unreliable volume is associated with worse product quality, then maybe the prices that are being quoted in these exchanges are going to systematically deviate from these aggregate prices that are applicable across exchanges. So I looked at kind of the average deviation from the aggregate price across exchanges in each one of these exchanges to try to get a sense of this, and I expressed everything in relative terms. And then I just looked at terciles according to these different measures. And what I found is kind of a little bit of association, not as clear, but some association. If you look at kind of this table, I look at the open price and the close price. So these are kind of the most reliable prices that we could think of, that I could think of. And then I rank kind of the 28 exchanges in my sample according to the relative deviation from the aggregate price, and looked at the median rating in that tercile. So what you can see is that first, one interesting thing nonetheless is that because most of these exchanges offer long positions, shorting is still relatively difficult in crypto exchanges. Exchanges systematically inflate prices. So you see that kind of the deviation tends to be positive and large. But the exchanges that have the smallest deviation from these aggregate prices also tend to have the highest reliability ratings, while the exchanges that have the highest deviations from aggregate prices tend to have the lowest reliability ratings. So there seems to be some notion that yes, this may actually be a good measure for product quality at exchanges. And I would encourage kind of maybe looking at this a little bit more because from my own experience, it seems to be that investors don't really think, or that exchanges themselves don't view necessarily their trading volume as kind of that much of a product quality signal. They view it mostly as a marketing signal to attract investors, consistent with this notion that Evgeny was talking about, kind of being a short-term kind of effect. But for the long run, what they view as the main determinant of whether customers are going to stay in the exchange is whether the prices that they're quoting are good or not. So we can get a better understanding of what happens to the prices that are being offered. That could also be a nice way to tie that in. Then I was thinking, do we really need to think about machine learning? I'm a super technical guy. I do machine learning up and down, but I think maybe just a little bit of more information about what these measures really capture and like what they're measuring themselves, not what they're associating, not what the exchanges that engage in fake trading volume are like, could be helpful in interpreting these measures. So one of the things that I was surprised about not seeing in the paper, and maybe I missed this, is that the volumes are always measured kind of in nominal terms. But I think what's more interesting thinking about kind of an abnormal measure of volume in excess of kind of what the market is doing. Think about this last month when the market boomed, trading volume in almost all cryptocurrencies was bigger. So what happens to kind of trading volume in excess of the market? And my conjecture was that if an exchange is engaging in large amounts of faking volume, then the trading volume that they report is going to be hard to explain with market volumes. So I regressed kind of exchange trade reported volumes on the volume of Bitcoin and Ethereum as a proxy for kind of the market volume. And there, what I find is very strong evidence that the easier it is to explain volumes with kind of the market volume, the more likely it's going to be that this exchange is very reliable in terms of the volume they report. So there seems to be some association in this regard, whereby if the exchange is deviating very much from the market, then there's something that's going on there that may not be fully correct. So my comment here is mostly, can we really dig into a little bit more into what these measures are, what they're really capturing themselves, and try to provide more interpretability kind of for these measures? Because I do think that the machine learning approach is good and valid here, but I think generally when selling these kind of things, it's important to provide a little bit more of insights. And then my final comment is like, well, is this a good or a bad thing? Is this something that we should really be concerned about? So Evgeny was talking about kind of the trade-off between long-term and short-term incentives for exchanges. But I think ultimately, most of these exchanges are companies and they have shareholders. So in deciding about whether or not the exchanges are going to be engaging in fake trading or in reporting fake trading. They should ideally be thinking about whether this like shareholder value maximizing. So I was thinking, is it possible to consider, say, like a net present value of these revenues that Evgeny was talking about, if you assume kind of reasonable discount rates over a certain period of time, to just get a sense of whether this is actually something that exchanges are engaging with because it is optimal for shareholders to do this in terms of like attracting customers or whatever it is that might be causing this. And an alternative thing, I didn't have time to look into this, but I think it's very interesting, is to look at kind of the exchanges that actually issue coins. Many of them do. Binance has a coin. Huobi has coins. A lot of these exchanges have coins that are also traded publicly, and the value of these coins is associated with how customers view the value of trading in those exchanges, and trying to see whether kind of the amount of fake trading volume that is detected by the methodology is associated with that normal price performances for these exchange coins. So this is, again, just providing kind of a little bit more of an insight. I'm not a corporate finance guy, so I don't know this literature in terms of the trade-offs between long-term and short-term incentives that well, but I think from an asset pricing perspective on its own, I think this would be something interesting to think about, whether this is kind of an optimal strategy in a way. I have a few smaller comments. I'll share this with Evgeny myself. But overall, what I think that this is a really cool paper that uses cryptocurrency markets to draw inferences for broader markets. It uses machine learning in a really cool and sophisticated way to identify fake trading. I wish there was a little bit more of interpretation of these measures. And then it shows that that essentially competition skews the product quality choice toward downwards. And there my questions are, is this something that's rational for exchanges to do? Is this shareholder value maximizing? And ultimately, how does it really affect the customers in exchanges in terms of the prices that they're actually able to trade at?
Thank you so much, Gustavo. Fantastic discussion. I'm not going to take time from your presentation. I agree with everything you said. We can talk, later on as well. But generally, I think those are fantastic questions. Looking at prices, reliability, and also kind of trying to compute the NPV. I think we should try to do this for sure. Thank you so much. So given that I'm a terrible timekeeper and we're slightly behind, I'll leave it to Gustavo to present his paper.
All right. Yeah, sorry. It's hard for me to keep track of the time too, because I have this in full screen, but I'll try to look at my clock. All right. All right. Great. So this is a paper co-written with my PhD student, Frank, from Boston University. And as I don't need to talk about this much, cryptocurrency markets are hot. This last month, the aggregate market cap went up to like over $1 trillion. We have $150 billion daily trading volumes. And what's more impressive is that we have tons of cryptocurrencies. There are around 6,000 cryptocurrencies traded on over 300 exchanges around the world. So as an investor, when you're trying to figure out what cryptocurrencies you should invest in, from a pure portfolio point of view, you really care about what drives co-movement across cryptocurrencies. So what explains the correlations across cryptocurrencies. And the existing literature has posited two channels that explain correlations in this market. One, of course, is the standard kind of factor model-based explanation that there are common risk factors that drive the cross-section of cryptocurrencies. And another really interesting channel posited by Amin Shams is that essentially that they're correlated demand shocks, whereby many exchanges are kind of geographically constrained. So if there's a local shock to that geographic region, exchanges that are co-listed in those cryptocurrencies that are co-listed in those exchanges may experience kind of co-movement. Now we posit a third channel for co-movement, which are peer linkages. So essentially our hypothesis is that cryptocurrencies that are similar should move jointly. And I'm going to present you three types of results. The first result is that indeed, this is what we find in the data. We find clear and robust evidence of co-movement across cryptocurrency peers in excess of the correlated demand channel of Amin Shams and in excess of common risk factors. And what's most interesting is that the movement we document is consistent with what in traditional financial markets we would label a competition effect and not a contagion effect. So what this means is that when a shock hits one asset, the competition effect posits that peers of those assets would move in the opposite direction because investors move their investments from the shocked asset to similar assets without considering kind of the idiosyncratic nature of the shock. A contagion effect, on the other hand, posits that when a shock hits one asset, investors extrapolate that similar assets may be experiencing similar shocks and therefore withdraw funds from those investments as well. So a competition channel would posit co-movement in opposite directions, while a contagion channel would posit co-movement in the same direction. Now in this plot, what I showed to you is the average, is the realized return of different sets of cryptocurrencies around event weeks. I'm going to explain to you what an event week is, but you can think about an event week is a week where one asset experiences a large abnormal return shock. And then I look at what happens to the peers of those shock cryptos and what happens to all other cryptos that are non-peers. And we find consistently in many different specifications that during during an event week, shock cryptos lose around 15% and peers of those cryptos gain around 5% in abnormal terms in excess of common risk factors and other channels. So this is highly statistically significant, but also economically significant. So this is the first set of results. During event weeks, we see co-movement. The second set of results is going to really focus on the predictability that arises through this. So what we find is that it takes investors several weeks to kind of recognize that these shocks are really just idiosyncratic in nature. They do not reveal information about peer assets necessarily. And therefore the shock and the co-movement that we outline is a mispricing. These peer assets are mispriced and therefore their prices should kind of converge again at some point. We find that it takes around 6 weeks for kind of the co-movement to fade away, and trading strategies that exploit the reversal of these peer cryptos can achieve high alphas of around 30% with Sharpe ratios of around 2 without loading on any factors. So there's a lot of predictability that arises because of this, and we find that the predictability is not is perpetuated by market frictions, but it can be really exploited through different trading strategies. And then finally, we show that we introduce a methodology to identify peer cryptos from online news data. So cryptocurrency markets are a little bit different in that there is no clear definition of industries. Some data providers classify cryptocurrencies into industries, but this is pretty much ad hoc depending on their own industry classifications and their own industry breakdowns. For stocks, for example, it's easier to see which firms are peers. For cryptos, it's not as clear necessarily. So we derive an NLP methodology that tries to read news articles online and figure out whether from the news, 2 cryptos that are co-mentioned in the same article are peers. This is an extension of a methodology that I introduced with Frank in a different paper, and I'm going to show you how we do it. It's kind of a pretty neat approach. We find that in crypto news in particular, when our methodology finds 2 cryptos to be peers, this tends to be associated with the fact that these 2 cryptos have similar market caps, similar ages, similar factor betas, similar Alexa ranks. So generally this tells us, and also are co-listed in the same exchanges and operate in the same industries. So this tells us that when we identify 2 cryptos to be peers, this is primarily because they share similar characteristics, which is exactly what we think a peer should be. So all the results that I'm going to show you are going to be based on this online news co-mention label approach to detect peers. But we also find similar and directionally equivalent results when we think about industry peers, but we just find smaller effects in that regard. So this tells us again that the news is in a way is really a primary source for peer identification in crypto markets, not just for us using NLP, but also for investors when they try to detect where should they allocate their investments to. The paper contributes to several strands of the literature, primarily to this big literature on cryptocurrency markets. We contribute by showing another channel, by introducing another channel of movement, and by showing that there's significant predictability in cryptocurrency markets. And then there's an extensive literature on competition and contagion effects across peer assets going back to like the 90s, and for stocks and bonds and many other asset classes. What we show here is that we provide very strong evidence of a competition effect in a new asset class, which is cryptocurrency markets. So I'm going to walk you through how we proceed with our data. Cryptocurrency data is pretty messy. We collect data from 3 different data sources: CryptoCompare, CoinGecko, and CoinAPI. We consider the 100 largest cryptocurrencies by market cap throughout our sample, and the sample goes from October 1st, 2017 through November 30th, 2020. We stopped the sample in October of 2017 because that's the first date when we have sufficient news data, and the news data we get from CryptoCompare. Overall, we're going to have around 90,000 crypto week observations, and based on the data that we have, we're going to build a market index, momentum factor, a size factor, and then compute abnormal returns and volatilities with respect to these 3 factors. This is kind of the 3 factors that have been proposed by other papers in crypto markets. How do we detect peers? Well, we develop an extension of this methodology that I developed with Frank, and the methodology is several steps in a way. The first step consists of using standard kind of NLP tools called named entity recognitions to detect the places in a news article where cryptocurrencies are mentioned. So these are the first 3 steps of the methodology. We're going to say that 2 cryptocurrencies are potentially peers if they're co-mentioned in the same sentence of an article. In our first paper, in our original paper, Frank and I go through a lot of work to make sure that this is a good way to do this. And then we add a 5th step, whereby if we have 2 cryptocurrencies that are mentioned in the same sentence of an article, we run that sentence through a novel NLP methodology called BIRD. BIRD is a way to extract a relationship or to extract kind of a connotation from text data. So the BIRD methodology looks at kind of the word surroundings around the cryptos that we identify to detect whether this sentence describes a peer relationship or not. So we say that 2 cryptos are peers only if they're co-mentioned in the same sentence, and this BIRD methodology identifies that sentence to be a competitive relationship. In cross-validation exercises, our BIRD model has around 85% accuracy rates in detecting competitive relationships. So we're confident that this is a really good way to label kind of what this relationship would be. We apply the methodology to 200,000 articles published online in an array of different sources. CryptoCompare aggregates all these different news data sources that include Bitcoin.com, CoinDesk, the blog, and so on. And we also run several experiments to validate that we're doing a correct thing. This is kind of the network of peer linkages we obtain. It includes 61 cryptos, so only 61 of these cryptos in our sample are actually related to each other, and there's around 330 unique connections between them. I'm not going to talk a lot about this because this is not necessarily important for the paper, but what I want you to think about is every week we're going to look at whether 2 cryptos are linked in this network in the time series, so this is just a static version, and then see whether there's co-movement across these linked cryptos. We're going to study the co-movement on event weeks, and we're going to have to define what an event is. We're going to think about an event as being a week when a cryptocurrency experiences excessively negative abnormal returns. So we're going to say an event is a shock that lands in the bottom decile of the distribution across cryptos and time of abnormal returns. We're going to focus on negative abnormal returns for now, even though in the paper we also have positive abnormal returns. And then because there's substantial heterogeneity in terms of these abnormal returns, some cryptos have small abnormal volatilities, idiosyncratic volatilities of like 1 percentage point. But some cryptos have huge abnormal return volatilities of around 30% per week. We're going to standardize all of our measures on a weekly basis using the 60 prior day mean and variance. So all of the measures that we're going to have are going to be comparable across cryptocurrencies. And that's why we feel good defining an event as kind of this bottom decile of this distribution that's not going to overweigh any kind of particular crypto. So we're going to say a shock crypto is a crypto that experiences a shock that lands in the bottom decile of this cross-sectional and historical distribution. And then we're going to look at kind of the peers that we identify of those cryptocurrencies in the week when the event happens. And we're going to run diff and diff panel regressions. It's a diff and diff regression because we have treated cryptos, which are peers, and we have the post period, which is the event week. But it's also a panel regression because we're going to have many different events. We observe something like 350 events throughout the sample. So this is going to provide a lot of statistical power for us to be able to make inferences about these co-movement effects that we want to establish. So what, okay, I'm running out of time. What the regression estimates show is that the peer cryptos in the week when we observe the event experience an excess abnormal return of around 4.5%, while the cryptos that are shocked experience an excess abnormal return of around -16%. So these are really significant estimates. They point to this co-movement in opposite directions. We find that the co-movement is primarily concentrated in smaller peers, and especially for shocks that are not informational in nature, in the sense that when these big shocks occur and there's not a lot of information about what is really happening, the prices of smaller peers tend to co-move stronger. This is consistent with prior results that tell us that something like investor attention, the amount of investor attention should determine kind of how much peer co-movement we're going to see in kind of equity markets. We don't find that alternative linkages explain our results. When we look at the correlated demand channel of shams that is proxied by being co-listed in the same exchanges, we don't find co-movement across the assets that we consider. But we do find co-movement across cryptos that are operating in the same industry, albeit only a fifth of the size. So again, this points to kind of the intuition. This points to our main result that peers tend to co-move during event weeks according to what we would say is a competition effect, but alternative associations between cryptos don't really explain away these findings. We then construct our trading strategies by looking at kind of how predictable are the returns of the different crypto peers in the weeks after an event. And consistent with this low attention by investors, we find that smaller peers tend to exhibit the strongest predictability. So here the black line shows the cumulative returns of smaller peers in the middle in the weeks after an event occurs, and the red line shows the cumulative return of the market. And we see that it takes about longer than 3 weeks for kind of these two cumulative returns to catch up. So we built trading strategies that exploit this predictability. And we essentially, every week, we look at whether there was a crypto that was shocked based on the, at that point, observed historical distribution of abnormal returns. And then we look at all the peers of those cryptos, and we're going to short those cryptos because we're going to bet on the prices coming down. To keep the strategy market neutral, we go long on Bitcoin, and then we keep these long short positions open for several weeks, which we call the holding period. We find that these strategies have statistically significant alphas, Sharpe ratios of around 2, and no market exposure when we keep these positions open for a very long time of around at least 9 weeks. And these results that I'm showing you here are results that are measured after fees. So we take the Kraken kind of fee schedule and apply the fees here, and all these performance measurements are all after fees. So again, this points to kind of the predictability being there, and that it's possible to exploit this predictability through kind of long short strategies that are market neutral. We find that the predictability is smaller for cryptocurrencies that have fewer trading frictions. So if we focus on the smaller peers that have active margin trading on Kraken, the Sharpe ratios of our trading strategies drop by around 1/4, and the as alphas also drop by around 1/4. So this again points to the notion that market frictions fuel or exacerbate the mispricing and allow it to persist, but they're not the main source of the mispricing. We can find this mispricing also among cryptos that are that you can short trade on Kraken. So this really just points to kind of attention constraints being kind of an issue here in these markets. It takes investors time to process that these shocks are purely idiosyncratic and they do not reveal information about the underlying peers. So in conclusion, we show that peer linkages are a key driver of crypto movement, and this holds after controlling for common risk factors and correlated demand shocks. And we find that this is primarily concentrated among cryptos with low level of investor attention. Trading strategies that exploit the reversal of this co-movement generate large Sharpe ratios and alphas. And ultimately, we develop an NLP methodology to identify peer cryptos from online news.
Fantastic. So thank you very much for a great presentation, also for keeping the time. So the discussion is Jin Page.
Thank you. Share the screen. Okay. Just one second. Okay. Thanks very much for inviting me to discuss this wonderful paper. So Gustavo did a wonderful job to present the paper. I just want to put this paper into the bigger picture about how this paper fit in the literature. As Gustavo did a great job and about the motivator, why crypto matters. I don't think we need to add more in this crowd, I would say. We all convinced. And just put it in perspective, right? The U.S. stock market cap is only about 50 trillion, while the crypto market is only been around like 11 years, right? It's been growing really fast. There's growing knowledge on the asset pricing side of cryptos, and this paper definitely fit this literature. And also on the other side, in the about stock market, is also literature about economic linkage and stock returns. People talking about the customer supply, and also there's paper look at conventions in news about stocks as well. So this paper essentially bridge these two literature, right? So about the crypto market, but also the linkage of the stock returns. So the summary of this paper, I really like the paper. Documents some crypto core movement interestingly in the opposite direction, which they call a competition effect. They show that the core movement cannot be explained by common risk factors such as size, market, and also cannot be showing that some other paper that looking at this core movement as well. Now you may wonder, what explain these core movement then? They show that it's not due to the information release. It's about mispricing. Although I found this paper study an important question, and it has very interesting result, and I'm convinced that the result is is very robust. So my discussion will mainly focus on a little bit about how to further improve the paper around several dimensions, sample and how they define the peer network, and how they define the shock events, and a little bit about probably discuss more about the asymmetry effect, but between positive and negative the shocks. Now, Evgeny also mentioned about discuss the sample that in my paper, right? So fair enough, right? So I think, as I mentioned before, there's no like standardized data set like crisp version of crypto. So and also of course when you start a project, you always start from kind of the a sample that you feel that is kind of popular. Currently the paper using 100 largest cryptos. I think that's already big enough, to be honest. So this will represent more than 90% of the market cap, right? But also mention that there's over 6,000 cryptos traded in the market. In the existing literature, people have been using kind of quite bit more cryptos. So, but I do understand, right? When you think about peers, right? In 100, you've got different, a huge amount of peers. But now, if you increase to 1,000, think about how many groups you can get. So it's also complicated things. I do agree on that dimension. But I mean, later on I'll mention. But also sample period. I think I agree that I think it makes sense, right? You want to have a sample period that there's a large amount of cryptocurrency already, so that you can look at the peers. But also there's some benefit about having some. Let's say go back to 2014 when there's only Bitcoin and Ethereum, right? So in that case, do you see, and then you look at that from that period until a recent period where you have more crypto, do you see a dynamic that can help actually to refine a story in one way or another? So I think there's kind of, I understand that I think the result is quite robust, I would say, but I think there's some benefit having a larger sample and a longer sample period, because it will actually help you to pin down and provide a rich story that it is doing. And also I think the paper is using some machine learning, and definitely machine learning, one important kind of condition for machine learning to have better performance is that a bigger data, the more data you're having, a better performance you are having, right? So this helps. So by no means that I am saying that the result probably will change or anything, but I believe that having a bigger sample will actually help you to probably even having better support for the story. Second is the peer network. So the paper actually mentioned that they're looking at the cryptos mentioned in the same sentence in news article. So my question is, why only two cryptos in the same sentence? I know that Gustavo and Chen, they also have another paper that motivated that. I truly believe that is great. I'm convinced that this is probably indeed what's happening. But I just wondering, what if that these two there are two cryptos mentioned in the same articles, right? So does this also mean something or not mean something? It's possible that doesn't mean anything. So I think it probably people are curious, right? If crypto, Bitcoin and Ethereum has been mentioned not in the same sentence, but in a different but in the same articles. Also, why does the relationship need to be competitive, right? I understand that one of the settings that the authors has been focusing on is that we want to identify the cryptos that have been competing with each other, not the contingent one. But this relationship is probably can be dynamic, right? What about sometimes they are competitive, but then they are not competitive in the other times, right? What if that Bitcoin and Ethereum has been mentioned in one article in the same sentence in competitive way, but not the competitive in the other ways? So overall, I think in the back to the kind of the question is, once you identify the peers, right, is this relationship kind of permanent or dynamic? If it's permanent, why it's permanent? What are they competing for? If it's dynamic, why they change? Why suddenly they're competing with each other? Why not it's not competing with each other? I think it's much easier in the stock market, but not in the crypto market, right? In the stock market, definitely, if you are producing something similar, right? Probably Walmart is competing with Costco, while Walmart probably is not competing with other companies, right? Probably they're competing not. Anyway, so I kind of mentioned well, it's not clear. I think it's going to be useful if the authors a little bit more tell us a little bit more about what are they competing for, is attention, technology, or the product. I think the way it also define the peer networks totally makes sense to me. And also I like the NLP, and myself actually doing a lot of text analysis. I like this type of method a lot. But it's going to be more probably it's going to be interesting to find a little bit more broader definition of peer network. Also explore a little bit more about the non-competitive competitive relationship. I found that not necessarily in this paper, probably, the contagion effect can be interesting, right? If you pay attention to the crypto market, you can see that, when the stock market, when the crypto market like Bitcoin is increasing, while Ethereum and other market will be also increasing as well. So I do notice that, the correlation between the crypto market and stock market is very low, but the correlation between cryptos actually is quite high. So the contagion effect can be also actually interesting. In terms of magnitude, it could be even bigger. There's actually a literature in the stock market look at, why, think about, the network centrality, right? Is that something like there as well in the crypto market, right? Probably Bitcoin, Ethereum, probably in the central market, once they're shocked to these, then will be spread out to the other crypto, while probably the other cryptos probably not like that. Of course, this is kind of very different directions, but I mean, the bottom line is the contagion effect that has not been studied in this paper can be interesting. And given the structure that you are already having here, it's very easy just to also, expand it to that area. Another thing is about the shock event. Right now, the current method is using top bottom of the return to identify, this event. Which I think totally makes sense, right? If one of the cryptos return move a lot, that means that definitely something happened to them, right? It's a shock. But another thing is like the return is good or bad in a sense. Like return can be, I think the story that the authors has been talking about is that the shock is idiosyncratic, not systematic. But the returns actually can capture both, both, systematic one and idiosyncratic one, right? So using the return itself can be, can be confusing in a sense. Now, to be honest, do we have a better way? I would say, probably think about, whether you have alternative way to define the shocks. One thing I can think about is, so in the stock in the stock return literature, they use so-called idiosyncratic volatility, right? So there's a given return of cryptos, right? You run regression about common risk factors, and what to the left is so-called idiosyncratic volatility. That part should be not affected by the common risk factors. Now, for given that, then you think about it, and then you identify which are the top, movers, right? Bottom movers, and then this part is going to be driven by the idiosyncratic reason rather than the systematic reason. Now, then once you have that, and you look at how this will affect the peers, probably is a little bit cleaner than the existing way. But I probably there's a better way that also is aware, but I probably not aware. But I think a little bit more on that, because I think this is important, right? Because you have to identify the shock event first before studying the effect. Another thing I found interesting is the asymmetry effect about, when the shock is positive compared to the shock is negative. So the result is stronger for the negative shocks, but weaker for the positive shocks. So the explanation the author provided is behavioral bias against downside risk, which I think makes sense. But on the other hand, behavioral story says that there's kind of disposition effect on the invest side, right? In general, people are investors are reluctant to sell when they are in loss, right? So so again, I think the downside risk story makes sense, but there's also other story that probably will go the other way. Again, I think having a larger sample, then you can explore a little bit subsample analysis, and can help. Also, I was wondering where this competitive and the competitive has something. This result is kind of mechanical, not a better way, I would say, probably in the way that they also define, right? So you identify negative shock, and you identify peers that are competitive, right? And then if they're competitive and some company having bad news, then probably as a result is stronger, while is weaker in the negatives. Now, what if, and one suggestion is a little bit more explanation why, I would say probably in the writing part, probably just a little bit more about why the result is weaker for positive shocks. another thing is how about define the peers differently for the positive shocks, right? If you think about the non-competitive ones, for the positive shock, do you find something similar? Think about it. You have combinations, right? The way you define peer can be competitive, non-competitive, and also the way you define shock is positive, negatives. So different combinations of these shocks and the peers probably can tell us a little bit more about what's going on with the stories. Overall, I think I found the paper is super interesting, and they construct a novel measure of crypto peers to study the impact on return co-movements. It speaks to important research questions and present interesting and convincing results. It can be improved in broad definition of peer networks, and as well as a little bit more analysis about alternative way to define shocks. I highly recommend everyone to read the paper. Thanks very much.
Thank you, Jennifer, for a great discussion. I know that we ran over time, about 10 minutes at this point. I do want to give Gustavo maybe have him to respond and any questions that address any questions that are there. We still have 20 minutes in the next session, so I think that should be right.
Okay. Yeah. Thank you so much. That was a great discussion. I really liked the comments, especially when it came down to like the positive shocks, and try to really dig down a little bit more about that. I do agree that the peer definition is machine learning, so it's always kind of the question of what are we really capturing. I like the suggestion of looking at a non-competition network and seeing what happens there and what other kind of links we can identify. That was a really good one. In terms of the same sentence linkages, we do a lot of work in our first paper, and we should do it as a robustness check here. I don't think necessarily much is going to change. And then in terms of expanding the sample size, we could do that. I could include like 1,000 cryptos, but ultimately the news is skewed towards kind of reporting about larger and more popular cryptos. So even among these 100 cryptos we have, only 61 are actually, or only around 80 are actually ever mentioned in the news, and only 61 are linked. So what I think the sample size that matter to us is mostly how many events can we identify, because this is kind of a cross-sectional kind of exercise, not so much a time series exercise. But I do agree that it would be better if we could have more access to a longer time series. That's kind of a downside of the data that we have, but it's a valid point. Yeah.
All right, thank you so much, Gustavo. So I think in the interest of time, I think we should just thank all three presenters and all three discussants, for the same people. And I also would like to thank Paul and Lan for organizing the conference in general, this session in particular. I personally learned a lot, and thank you so much.